Good morning, everybody. Welcome to the Flow Show. Another busy day ahead, or busy morning even. Morning, Kay. Morning, Dale.
Morning.
Hello. Is it busy?
Here they are. Yeah, fun old day today. Already kicking off. Don't like it too busy when I first sit down in the morning, but that's markets for you. Lots to talk about. Obviously, UK CPI among one of the bigger stories, but we'll get onto that shortly. Let's crack straight into it. China's NDRC, which is the National Development and Reform Commission, say they are drafting plans to boost the recovery and expansion of consumption. A spokesman said that currently we are working on drafting documents on the recovery and expansion of consumption, mainly focusing on key areas such as stabilizing big ticket consumption, enhancing service consumption, and expanding rural consumption. So there's going to be some measures coming out pretty much saying they want to boost spending, even though they've seen a decent rebound in the data as we saw yesterday. They want to keep continuing that and making sure it lasts. So we'll have to wait and see what magic they pull out the hat for that one. Over in Japan, bit of data overnight, and we'll get that up. Let's see where we are. The tanker numbers, which are reflective of manufacturing sentiment coming in down -3, worse than expected. The -1 expected, so I was expecting a slight improvement there, but matching the prior number as well. Industrial production not looking too bad there as well, beating expectations, but down on the month, 4.6%. Capacity utilization a little lower than expected, but up on the prior month. So all in all, not too bad over there. On the BOJ front, Executive Director Shimizu said that CPI growth is likely to slow below 2% in the middle of the fiscal year 2023, and it's appropriate to continue the easing policy for the time being. A bit of a repeat of comments on the easing front, but still the BOJ and a lot of members not expecting inflation to stay up and are expecting it to head back down below target. We had headlines this week about what they might expect to do in their forecasts, particularly for 2024, 2025. And we saw that some of those forecasts were coming in below 2%. There was another one out yesterday saying that it may come in around 2%. So we really need to see what the BOJ are going to do with their forecasts and those inflation measures. If they keep everything going forward below 2%, that's going to look pretty dovish on paper. If they take it above, that's going to be more hawkish. So the BOJ meeting could be a question of what they say on the initial announcement on the day and where they see inflation in the future. And the market will adjust expectations based on both those points. But we await to see that next week. So fun and games in the UK. The market expecting inflation to come down to 9.8% from 10.4%. It didn't. It only dropped 3 pips to 10.1%. The core number as well stayed at 6.2%, sticky as we've seen elsewhere, was expected to drop 2 pips. There has been some fallout in inflation in the PPI numbers. Output prices down more than expected and down on the month before. Input prices year on year down also, but again a bit stickier than the market expected. For the UK, we get input and output numbers. So this is prices coming into firms and then what they charge on the other side going out the door. So it's a bit of a margin view, if you like. So based on that, input costs are below output costs. So in a rough sense, the margin is in favour of firms who obviously taking in costs and then passing them on to the consumer. RPI number as well, still looking very strong at 13.5%, beating expectations and only a small drop over last month. Now, a lot of the inflation that came into the UK in this month was down to fresh food and other food items as well. But it all says the same message, that inflation isn't coming down in the UK as far as it is elsewhere. As you know, I've been saying that's going to be the case for a long while. Now, what does that mean for the Bank of England? Well, it's meant that, as usual, everyone's been getting the Tipex out on their forecasts. Morgan Stanley dropped to 25 pip hike to 0 in their last call, and now today they're expecting 25 pips again in May. So they've done a 180 on their prior call. Some traders have raised bets on the peak BOE rate hitting 5%. Interest rate swaps are now fully pricing a 5% bank rate by November. So the pendulum is swinging once again. For the UK, what I'm expecting from now on is we still, as Still mentioned yesterday and we've been mentioning, we're still in the midst of pay strikes. So there's still a lot of that in the pipeline to come through. We still have strong food inflation, as we know. We still have strong energy inflation, as we know. At some point, energy inflation is going to start dropping. It may not be until perhaps June. When that happens, I'm going to expect CPI to start showing the same type of moves we've seen in Europe, where we've seen, inflation dropping by 100 pips in Spain, Italy, France, that sort of thing. But I'm not going to expect it to drop too far. Maybe it gets from 10% down to 6, 7, 8%, and that's where it holds up for the foreseeable future. So my call for the Bank of England, continue on to 5%. I'm sticking with that they're going to be forced to hike further than they expect. What damage that does to the economy in the meanwhile remains to be seen. But the higher rates go, the more of a crunch it's going to create on the UK economy. And probably by brute force, that will get inflation down. What are you guys making of all those UK numbers?
Well, it came in stronger than expected. We had an interview with Dick Matthews yesterday who said exactly that, and he was spot on. That's on the Trader Summit site. But yeah, I mean, I agree 100% what you're saying. And we've said so many times how the inflation rate in the UK and in Europe, but more in the UK, is going to be stickier than, say, the US. And this is what's been manifesting. And I agree with your assessment that eventually, it's going to start dropping. But for now, the Bank of England has really its hands tied. I mean, they cannot be doing anything else but hiking with 10% inflation. And yes, we're dropping a little bit, but the pace is low, and we have been at around 10% for the past 6 months, 6, 7, 8 readings, whatever it is. So, if I was Bank of England, I would be very worried because they cannot do anything else but keep tightening. There is always the counter argument that, look, the economy, global economy, same. We also saw earnings, average earnings yesterday beat quite comfortably. We were expecting a 5.1% down from 5.9 and stayed flat at 5.9. So second round inflation effects still going to be there. And I don't see how that's going to come down, at least not in the very short term. So my assessment now is I think the pound will be relatively resilient on the back of central bank divergence, especially compared to the Fed, who is expected now to pause. One more, and that's it. So yeah, difficult situation in the UK, I must say, and you guys must be seeing it with the price of goods just being stubbornly high. Everything, right?
Yeah, petrol remains high, fuel remains high, shopping prices remain high. It all remains high. There is no let up in it. Yeah. Energy prices the same. It's still costing a fortune just to switch the heating on, which I've padlocked up the cupboard now and switched it off so the wife can't get at it. We're in April. The heating's staying off until December.
Yeah.
But Kay, what are your thoughts on the UK stuff?
I wouldn't know, mate. I'm stuck in front of my PC. I have no clue what everything costs outside. Now, jokes apart, yeah, it's going to force their hand, and it's going to force the hand of a Bank of England which does not want to hike, and that's I may spell trouble ahead. Because I mean, I've always been saying it's not because inflation is going up and a central bank may be forced to hike because of it that it's good inflation and that it's going to help the pound much. But now, just on the basis of central bank, I do think that the pound should, in a way, remain supported at some levels. And also, we have seen that actually the latest data are not bad. So I personally would still be in the camp of buying sterling on dips, but remains to define what a dip is. And that's going to be the tough one, because this morning but the market is very typical of what I'm just saying this morning. The cable was trading around 124.25 when it came out, jumped up to 70, went back down to near to the figure, and then we jumped back up to 70, and we are now lower again because the dollar is bid today.
Yeah,
it's quite bid actually today. The dollar, if we're going to talk about the other pairs, but it's pretty bid.
yeah.
And I think that's the effect of the dollar. But then if you look at sterling crosses, they are still higher than where we were yesterday. Let's put it that way. Yeah, this is one, and then you have probably euro sterling is a bit lower. So then the sterling commodities must be higher in all of these as well. Still thinking about stuff like sterling CAD and things. Sterling Aussie, you see we have the jump, and that's and I think that's perhaps where we have to look for it, unless the dollar starts to weaken a bit, in which case the cable can recover to that 127 or so that I was looking at one stage. But yeah, I think it's going to be a difficult read, but if the data hold up, then I think sterling could actually continue to do pretty well right now, although I don't like the inflation, what we're seeing.
And the thing we've got to remember, particularly with the Bank of England, okay, they have as much control over inflation as they do the tide of the Thames, okay? So on paper, like every other central bank, they should be hiking rates higher. However, it doesn't matter, because they're not really going to affect inflation anyway. So what they're going to do is hike when they don't have a reason to hike, or it won't make an effect, but they'll need to hike because that's what central banks do. But on the other side, they're going to create a bigger problem and worse problems for the economy, because rate hikes are going to crunch the economy probably worse than elsewhere. So their hiking is likely to do more damage than good. This is the situation the Bank of England has always been in. I don't understand it entirely, but inflation has always been a bigger problem in the UK than it is for everywhere else. The economy, Michael's just asking, how's the rest of the economy? I was having this conversation on Twitter this morning. There's two sides to the economy, okay? There's the mainstream media picture that's painted, where everyone's drinking water out of puddles and searching in bins for food, and we're absolutely a third world country that can't get on. The reality is, though, at the moment, people are still spending, people are still getting on. There is an adjustment going on as higher rates kick in, people refinancing mortgages and whatnot. So discretionary spending is probably getting a hit, but people are still going to the shops and buying food and putting food on the table. Pay is still going up, jobs are still strong. So the real picture on the ground isn't one of panic, but it could head that way if the BOE are forced to hike rates higher than they expect, and it still won't have a marked effect on inflation. You mark my words. So it's a very funny situation for the UK. But if you're looking to trade it, looking to trade the pound on the fundamentals, look at what the whole of the economy is doing, maybe more so than what the central bank is doing, because they are just, for want of a better expression, pissing in the wind, whether they're hiking rates or cutting rates, far more so than any other central bank. But Kay's absolutely right. You know, the pound is doing what the pound is doing at the moment. You've got to look. You've got to pick your poison. You know, we said right at the beginning of the year, and I can, you know, put up the blog again that we posted right at the beginning of the year. The crosses are going to have bigger says in things than the majors this year. And look at cable. Cable's dipping on that inflation number, but every other pound pair is looking stronger on the crosses. So if you're going to trade the pound, look at the best markets to trade it. It may not be necessarily against the dollar. And moving on to the dollar and some of the effects we've seen. Yeah, go on, mate.
Ryan, yeah, what I also would like to say is that I'm seeing comments by Abir about the housing market. A lot of the problems that we see now, of course, we have typical UK issues, and Ryan already spoke about that, about the consumer and everything. But look at how the housing market is. I mean, also Australia is worried about their housing market. Canada is worried about their housing market. In the US, everybody's talking about the commercial real estate. I mean, which is part of the broader housing market as well. If we take everything into context, like construction and whatever, it's everywhere the same. I mean, that's the thing. If we look at it as traders, it's everywhere the same. A lot of what's going on in the market, in the major countries, I'm saying, of course, a lot of what's going on in the market now is the same everywhere. So if as trader, you have to look perhaps at when everything is the same in the global market in one aspect, then you're going to have to look at other stuff like consumers, like PMIs, or like earnings, like we have, for instance, in the dollar market in the US right now, which are going to be other drivers. Correlations don't always stay the same, right? And if they are the same everywhere, it's tough to trade them, right? So I just wanted to say that, because it's when we look at one country, we point to the difficulties or the good stuff in one country, but then we have, if we want to trade it, there's always the other side of the pair and what's going on the other side. And for the time being, barring perhaps some discrepancies here and there, it's a broad phenomenon, right? Where the housing market seems to go up and down globally in the majors. So I think we have to look at other data. And the good thing yesterday was for instance, that UK jobs report. It's not bad at all. Okay, there's been a bit higher claimant counts, but and it's 0.1% move in the unemployment rate, but 167,000 people went to work. And that's what we have to look at as well. If you look at a market or a currency, I think now more than ever, it's really important to look at the data. And as people in our room know, I'm a very, very big fan, and I do it a lot. I trade a lot of cross currencies. If we are uncertain about the dollar moves, crosses sometimes can be a lot clearer than what dollar pairs are telling us, if everything goes a bit the same in the global market. Yeah,
that's excellent and valid analysis there of looking at things like housing and stuff. And housing is an important data point. As Kay said, everyone's facing the same issues. Okay, rates are going up. That's going to impact housing. That's going to impact mortgages. You know, as sure as the nose on our faces. It's how it affects it. You know, I would have been expecting to see the US housing market suffering a bit more than it has been. We've seen it in some areas like the NHAB that absolutely collapsed as rates were rising, and you know, mortgage levels were getting up to 7%. But it's calmed down a bit now. The UK is going to be the same. Everywhere's going to be the same. So we may see trouble in the housing market, and the housing market can be a good indicator to see early warning signs. But it's how bad it gets. You know, if it's just a small correction, fine, then everything's fine and dandy. If it's something bigger, we'll know it early, and then you can look at maybe what you do with the pound, or any other currency that hits some housing problems. But it's like any other data. Is it bad or is it really bad? And then you can trade off of that. But coming back to it, you know, what it's done, and this is a bit of a surprise, because we saw yields jump across the board over the Bank of England data. US yields spiked up. Obviously, UK yields have spiked up. European yields have spiked up. Wherever you looked, we've seen a spike in yields, and it's not often you get the UK causing a big reprice in the whole of the global yield space, but that's what's happened. And the reason that's happened is that the market, through all the data, UK, European, US data, is now swinging the pendulum from pause with the next move being cuts to now pause with the next move maybe being hikes again. So it's another case of running from one side of the boat to the other. We get a series of crappy US data in the next, 3 big data points, and it goes the other way again. That's the market we're in at the moment. So like we've been saying for weeks, at the moment, you've got to roll with the punches, because the trends aren't really there and they can flip in an instant. So if you've had a good bit of move today, you're the right side of this one, take some profit, lock in the rest, and just in case it all goes the other way once again. But anyway, let's crack on with some of the other headlines. SMB's Makler said that inflation is back with a vengeance, and monetary policy is back to using traditional tools. Swiss inflation is lower, but still a worry. March's 50 BP hike is still only slows inflation to 2%. Over to the ECB, and ECB's Lane said the baseline is we should raise rates in May, but won't commit to what he thinks the size of the May hike may be. Another bank flipping the coin on where they expect ECB rates to go, and that's Goldman Sachs. They now see a peak terminal rate of 3.75% on the 17th of March. They only expected ECB to raise by 25 pips in May versus 50, and they brought their terminal rate to 3.5% from 3.75%. So now they've gone the other way, like Morgan Stanley and the BOE. Once again, these bank forecasts are not worth the paper they're written on. I wouldn't even waste a paper on them. They change like the weather. They seem to be changing every 5 minutes these days. So if you're a follower of bank forecasts, you might as well look at the tea leaves for as good as they are. Moving on, US housing starts came out yesterday as well. Let's just close some of this down. Speaking about the housing market, nothing really to take from the numbers there. Building permits came in lower than expected and down on last month. Housing starts beat expectations, but was a bit down on the month before. Still, there's nothing here to suggest that there's any big problems in the housing market. We get the NBA data today that gives us a little weekly look at what's going on. That's been a bit up and down. So again, no trends really flagging any problems on that side. Fed's Bullard said there's not much clear progress on inflation, which means interest rates need to continue to rise. He sees adequately restrictive policy at 5.5 to 5.75%, with a bias to hold for longer until inflation is contained. So one of the big hawks over there. Fed's Bostic says the economy still has lots of momentum, but inflation is too high. He expects one more rate hike, and then his baseline is to hold rates after the next hike, and expects when the Fed ends hikes, they'll need to hold for quite a while. More inflation from Canada. Not too much of a shock anywhere, really. Headline CPI coming in at 4.3% as expected, confirming a dip from 5.2%. Some of the core numbers as well, all pretty much falling. This one, the common, falling more than expected, down a good chunk. Some of the others also falling more than expected, down decent numbers as well. That keeps the BOC likely on pause. They're still worried about potentially having to hike again if inflation picks up, but there's nothing here to say that's going to be happening anytime soon, at least. BOC's Macklem says they need to see wage moderation to get inflation to target and cannot rule out another rate hike to curb inflation. He was speaking at a parliamentary hearing about the monetary policy report released at their last meeting. Canada's financial regulator has said they're flagging housing market downturn and interest rate pressure on liquidity and funding among the top risks for the Canadian financial system in 2023-2024. What do you make of the CAD data, guys? No change really for the BOC on that lot?
Yeah, we covered it live on F.A.C.E yesterday, and I think I said at the time, I think there's definitely not market moving. It's as expected, roughly. It's again, North America, it's similar story in inflation. It's remained lower than say UK or the Eurozone. And so I don't think any pressure on the Bank of Canada to do anything at the moment on this number. So a bit of a dud for me. I don't know what Kay thinks.
Hold on, guys, because I don't know where, but there's a headline out saying that BOJ is said to be wary of tweaking yield control in April, and the dollar yen and the yen process got a bit of a slap there. Okay, I don't know
Well,
what's
gone up and gone down.
Sorry?
It's gone up and gone down.
Well, it's gone down, right? I mean, dollar yen is about 25 points lower. I'm just keeping an eye on it. Now, about the Bank of Canada, I don't see any change, right? They're probably on pause. I didn't hear anything specific from Macklem and Rogers either to tell us that anything different. CPI came off a little bit. Canada failed to really move on the back of it for a long time. But now Canada is a tad weaker, but not really on the crosses either. It's all versus dollars. So yeah, for the time being, I'd say, I mean, Bank of Canada still in pause, right?
Yeah, exactly. Thanks for that little nod, mate. I've just taken some of my my short off that I put on there in dollar yen up at 95s for a bit of a scalp and a big figure. So fortunately, one headline going my way for once. Right, coming over to the US.
Enjoy it. It's going to happen in like 3 months again, so enjoy it.
Yeah. Going back to the US and the old debt limit punch bag that's been kicked around. House Democratic leader Jeffries says the GOP offer to raise the debt limit for 1 year makes no sense. So back to kicking things back to the ping pong over there. Now, Gazprom has popped up saying that Europe may face difficulties in filling its gas storage to last year's levels. They say Europe got through the heating season thanks to a warm winter, but this is not guaranteed in the next heating season. Obviously, Gazprom, the big Russian energy provider. Again, this is something that is going to be floating in towards the next part of the or latter part of the year, and particularly when we're talking inflation again. Germany is likely to miss its gas storage goal in winter 2024, says INES. So as much as we're heading towards the summer and we should see energy prices coming down due to that, we still may have a problem later in the year when they've got to fill the storage up again, and depending on where they're getting it from and how much they're going to have to pay for it in Europe. So that inflation issue may raise its ugly head again into the latter part of the year if prices are still elevated. That's just something to put on the post-it note for a few months in the future. That's all I've got. If anybody's got anything they want to throw in, now's the time to do so. Okay, Stel?
Throw in or throw up? No, nothing from me. We have Tesla, right, by the way, announcing earnings today, and it's Tesla is obviously a big mover, so we need to be aware of that.
Yeah, thanks, mate. Thank you very much. All right, give me 1 second. Someone keeps phoning my bloody phone, even though I've got it on silent. Don't know what's happening now. Let me switch that off. Yeah, sorry about that. Right, so let's get stuck into it. So we're going to look at dollar yen. As just mentioned, I've had a little short up to this 135 area, which I've just taken a few pips for, just a short-term play of the big figure. I have got a core short still running, which is offside. I'm feeling like I'm pissing into too strong a wind to stay in this trade. I would like to stay in the position until the CPI. That'll be a bit of a decider. If it comes in hotter than expected, I'll be more happy to stay in shorts. If it's much softer than expected, I might look to reassess the whole trade, get out, and come back another time. I have been expecting dollar yen to move higher on the BOJ side of things, but this has got a second wind with what's going on with the US data, and as we've seen with the market's views of inflation generally. So, as I say, I don't like being in a trade if I'm facing too strong a wind. I'd rather get out, reassess, and come back another day. But I want to try and get this to the CPI data. So if it stays below my stop, then I might be happy to stay in. If it blows too much, I might just chuck it away. As I say, come back another time. Euro sterling, speaking about the crosses, had the move down this morning, got down to that 88 handle, 87.90. I spoke about this in the room yesterday, this area. We've had a bounce there. It's still looking a bit weak, coming off those highs that we saw at 88.60s. Again, I'm still long in this one, and I'm having thoughts about it, whether to just get out and then again come back another time, or look maybe to see if we get moves to either end of the range to play a bit of a range play. We're still stuck in this sort of 87s, 89s area, and I don't see any real fundamental reason for that to change, even with the possibility of the BOE becoming more hawkish. They'll still be outweighed by the ECB being more hawkish. That's why we've got a bit of moderation going on in this one for the moment. So that's what I'm looking at for euro sterling. Not got my BDIs much on anything. I know Kay's probably going to talk about it as well. But dollar yuan has had a little nudge up to this 91 area. Can't get through at the moment. It looks a bit similar to what we've been seeing, where we sit around the 688s, 89s, then have a little look down and have a little look up, but don't really build on any of those moves. And then we sort of revert to mean. So keep an eye on it. I'm not overly keen on trying to short into this level, but I don't know what happens on the break either, whether it takes us up to that 7 or whether it just has a little bit of a leg walk, a leg stretch, and then we come back down again. Kay, what are you thinking about this one?
Well, I was going to say, and good you brought it up. Yeah, it's trading around the resistance. I'm really tiny long just to see if it's breaking or not, and I will buy more if it breaks. But I'll let it go if it goes back below 690, and will be like a very small bait for bigger fish, but no catch. It's all. So the market yesterday, as we said, had already a very shallow reaction on those data, and then the PBOC didn't move where they could have moved, the LPR, but then overnight comes out all those comments about yeah, we are going to continue to support the economy, so meaning throwing a lot of money at it still. So I guess coupled with the geopolitical situation, that is just keeping the CNH under the cosh. Now here it's a bit of a flip the coin if it's going to go or not. I reckon if 691 goes, there's probably going to be models getting triggers to at least go visit like that 690. What is it? 695 and a half, 696 or so. I'll be very happy if it goes up there, because I'm not sure whether there's for the time being any longer term position to be had in CNH. It's still quite cloudy.
Yeah, no, I agree with that. It shows how we view markets sometimes. If you look at that from a technical perspective, you think, oh, that might be a decent short off that 91 level, but you're looking at you know, as I spoke earlier, which way the wind blows, and you don't think you want to do it, sort of thing, is it? I mean, you've gone long pretty much near the top, so you know that shows your conviction about what might happen in this one. But yeah, it's a funny one. I don't know what to do with it right here, right now, purely based on the price action we've had for the last few weeks. But a tough one anyway. Kate, you the cross man. Do you want to have a look, or Stel? Stel's got some magic.
No, my turn.
Yeah.
Stel's turn. Right,
So,
off you
hold
go,
on.
mate.
Let me take this screen. Share desktop one. All right, so a few things moving today. So I've got some things to show. I always start with yields, and we are getting to a little bit of a minor, I would say, but it's still a resistance level. Confluence of FIB and the 50 DMA coming in at around 365, let's say. So we're there, basically. So a little bit of a decision need to be made by the market. We're either going to grind back down towards these lows, or we're going to 4%. It's going to depend on a lot of things, basically on the Fed, but on the economic data that we're getting and how things are going in the US. My personal view is that things are probably a little bit worse than we think at the moment. I think we're going to see a slowdown. Are we going to see a recession? I'm not as sure as many other people are saying, oh, it's going to be a huge recession. I'm not sure, but I think definitely a slowdown for the next year or so is on the cards. So if you ask me what I think happens, given the fact that I think inflation is going to keep dropping in the US, I think yields probably find resistance here and edge down towards the 340s. But this is what we have now. So we are getting to this resistance point now. Risk, I still think yes, we're going down today a little bit, but I think this is going to be a slow grind higher towards 4,200. If these stops, you can bet there are loads of stops above 4,200. If these get taken out, oh yeah, I think I don't think we're going to go 42, 42.20 and reverse. I think it's going to be a bigger move. In the short term, it makes no sense to be long equities at the moment for me, but in the short term, I think most likely we get to 4,200, we take the stops above, go a bit further up, and then we're going to get into good selling opportunities. So I think path of least resistance remains to the upside for equities. Similar story for the DAX. DAX actually obviously doing a lot better, hitting new all-time highs, which is incredible if you think about it. Think about what's happened in yields recently, Russia, Ukraine, China, everything. Really not a very good geopolitical environment or rates environment, and yet equities in Europe are just flying. So I think the path of least resistance is higher. I'm not going to repeat myself a million times. Oil is interesting because we gapped a couple of weeks ago. We kind of tried to break out. It's back in the middle. It's difficult for me to trade this. I really don't know what to do with it. It's been torn by two forces. One is the tightness of supply, which remains, and the other is this big risk of a big global slowdown. So if you ask me to trade it, I'll tell you no, thank you, and I'm not going to touch it. Let's have a look at metals. Well, we talked about metals. K and I took some profits. Turned out to be pretty good, actually. 25.62 for me. I think K was pretty close to that in silver. This is what I drew at the time, and I think we're getting there. I have my bids in between around 24. I have to check exactly where I put them, but it's going to be around the 24 level. I'm going to probably move them a little bit as price action continues, but 24 is really what I'm looking at. 23.80 to 24 is the range, but as always, I'm going to be having itchy fingers to get that position back in. And frankly, if we manage to get $1.50 on this little tranche, I'm going to be very happy with that. And I'm sure K is going to be too. But, this pullback was expected, for all of you who have been listening to us here for the past weeks. We were talking about it. Both gold and silver went very quickly, very far, and a resistance. We're talking about this resistance zone in gold getting close to all-time highs. I bet if you pull a line from here to here, okay, not quite, but you know what I mean. This was always going to be a pretty important resistance level, and we have retreated straight back from that. I think in 1900, this area around 1900, 1920 is first support level. We could go through that, but if you've been short from up here, I think that's a nice place to take some profits. But as I said before, this is what I expect for silver. This is what I'm going to be trading, and that's that. Platinum is interesting because it kind of broke out, but it's trying to come back within the descending channel. Could this be a false breakout? Yes. Let's see. Let's wait for a little bit more of a of price action. Yesterday was a really big day for platinum and palladium, both up 3-4%. Retrace today is normal, but let's see what happens. Cryptos are, of course, they got me scratching my head. Bitcoin, we were talking about this 29.3, I think it was 29.2 as a breakout level. Well, look at this. We're back retesting it, and it has to hold. If this goes, yeah, it's not going to look good. I think if this holds, we're going back to the to 27 and probably testing these lows here. So if you're a bull, you need to see this holding. Ethereum broke above this resistance zone that I had drawn for a while now. It's coming back in again. This also has to hold around these levels, otherwise we're going to be going back into the range, which is 1860 to these lows here, 1100. It's huge range, I know. But cryptos, I don't know. You guys know why cryptos are underperforming today so badly? I know they're a risk proxy ×3, but this is ×5 today, so I don't know what's happening. Anyway, not looking great today. The euro dollar, well, I had been saying for pretty much most of this move that we're going to see 110. We saw 110, we passed above, we had to take some stops above here. This looks like now a potentially a false breakout above the highs here at 110.30. Yeah, this doesn't look too good if you're long euros now. 110 was my level. I didn't have a long. I was synthetically long with the silver, but if I had that position, I would be taking it off at 110, and now I don't. I'm not going to touch it. So this looks like it's retracing. What do I think? Where can we retrace? I bet this is also. Yeah, I think the 50%. 108 is a big level. It's near these lows here. The 50 DMA is going to be converging there. I think 108 is the next support. I know I'm not like the other guys who day trade and they have resistance and support levels 10, 15 pips away from the price. I tend to look at a little bit of the bigger picture. Oops. No, don't want to do that. Delete that. Cable is also interesting because it broke out of the channel. It's retested twice. I still think cable is a buy on dips, but this recent rally in the dollar is making it a little bit more tricky. But I think as long as we remain above this channel resistance, support now, this is a buy the dip instrument. And today's UK CPI reinforced this view. I think the central bank divergence will remain, especially against the Fed. So the BOE against the Fed. The ECB still has some room to go in terms of tightening, but I've talked about euro pound. My target was 90. I turned neutral there. I have no interest in the euro pound at the moment. It's for me in absolute no man's land. Now, if these lows here, 87.2, get broken, I'm going to be looking at this because this is going to be breaking the 200 DMA as well. I think that's going to be a nice little technical move if we do get down there. But for the moment, I'm just observing. This one, Euro Norway, I want to short the crap out of it, but I'm not touching it yet. I think 1173 could be a level. Again, if I do something, I'm going to put it in the chat room. And but this is a trade I really want to do. I hate the Norges Bank for constantly selling kroner, but we are at levels which, barring the COVID spike, which was let's face it, a completely one-off event, at least for the past few years, we are at all-time highs. So and it doesn't make any sense to me. So I'm actually going to put an alarm here at 72.5, maybe just below this 73 level, to start tentatively shorting some. Yeah, that's pretty much it. I don't have anything else. The other currencies, I don't have much to say. I don't have any. We are kind of in no man's land for a lot of pairs. I mean, this is right in the middle of the big. I know it's a big channel. I know it's 2,500 pips. I know it's the way I look at things. But we are. CAD is actually interesting because we have, these lows here and the 50 DMA. So break below here could be a nice opportunity to short. But a lot of things have to happen until then. I still remain of the opinion that the dollar is going lower, quite a bit lower in the medium term. I think these lows are going to be broken in the Dixie, and when that happens, well, what can I say? I think we're going probably towards 95. But
hurry up.
Yeah, but for now, this is very important support, and the market just respected that. And we have to respect the market's decisions. For the moment, I'm not chasing the dollar lower. But I think the time will come. So, I'm waiting on a lot of things. I'm waiting. When I do have the levels, I'm going to be in the chat room. I'm going to be posting everything that I do. Until then, I'm going to be boring you and not give you anything more. Yeah. Anyway, that's it from God.
Yes. When is your next position planned for? Because you Greeks, you have a bit of a different time frame than we do, than we normal humans do. So looking at the dollar Canada, is there something that you're planning to come up with in 2032 or so? Your next trade? I'm joking, man. I mean, it's good to look at the wider picture. That's what we always say. So it's really it's good to have a look at things from a broader perspective, and that's what everybody should do. You should, if you look at charts, even if you are maybe not the 5-minute trader, but if you are like working with shorter time frames, we always have to know what the bigger picture tells us before drilling down to what the day-to-day may bring us. So it's very good. And those wider levels should be on a post-it somewhere on the side of your monitors.
Absolutely agree.
Sage advice as always, Kate. Always take a look at the wider picture, because that 120. Oh, he's taking it away now. That 120 level.
Oh, sorry.
Put it back. That 120
hold on.
level. If you're an intraday trader, you might be trading in and out from 134 all the way down to 120 and not realize that 120 is actually a huge big level. So that you can get caught up in the short-term noise sometimes and not have an idea of what the bigger picture's looking like. So as Kay says, always go up and down your time frames in your chart, whether it's once a week or whatever. Just make sure you know the wider picture.
Isn't it interesting how technicals work? I mean, look at this impulsive move here, 50% retracement, twice respected, and look at the move from the lows here to the highs and from the lows to the highs. I mean, percentage-wise, they are massive for an FX pair, especially big, not a Swissy, Israeli, whatever is shekel. This is a very liquid pair, and it's huge moves, absolutely huge.
Yeah, those are the moves you've got to look for, because you hit one of those and it can make a year. It can make 2 years. So, always got to keep an eye on the wider picture. There's plenty to look at, as we know. Kay, you got any bits and bobs you want to look at quickly for the last few minutes?
It's as you wish. I can perhaps look at a bit shorter term sterling. Since we have this this CPI, so first of all, euro sterling still in this downward channel. I'd say for the time being. And 88.10 was a bit of a level. This morning we crashed through it on the well, I mean, on the second attempt after the CPI. And if we look at it, we had a little retest of this zone just a short while ago, and it seems to be respecting this trend line a bit. So in the really short term, 88, 10, 15 is probably going to be the level that we are going to either reject, or if it goes back through, seeing a bit of short covering if we get back above it. But in the wider picture, we could argue that we are in an 87, 89 range right now, or in this channel, or really look at it from rather from a range or a triangle or whatever you want to look at it. It's still a bit stuck here. And we are going to need a different catalyzer, in my opinion, to unstuck it. And that's why I was talking about the real data. When data come out, the real ones where we can differentiate one from the other currency, that's likely where this is going to move, or something out with politics or so for that. But for the time being, the range, I still think there is a chance to get back towards this zone. As I said, I'm still relatively positive sterling for now, but the market may choose to trade euro and the sterling perhaps on a bit of a similar footing than really the taking them as separate currencies. On sterling yen, just a question about sterling yen. Look at this. Yes, we've broken this trend line, which we were looking at in the room yesterday, 166.5. It's clearly broken. Also helped by the CPI, but already yesterday we had the attempt to break through, and it's this is going to be your first level to look at, 166.60. Give it. It's sterling yen, right? So it moves relatively quickly. So give it an extra 10, 15 points perhaps. But interestingly, we are now visiting this top side of the wedge, and that lies around 167.90. We had it as dollar yen was testing and had a quick look above 135. We went to tag this top line of the wedge. So keep an eye on that one. If ever it would go, then we are looking at levels that we've seen at the end of 2022, closer to 170, somewhere above around 169.25, let's say. That those could be targets if the yen continues. I was just reading quickly this article. It does. Even though Bloomberg says people familiar with the matter, it does really seem like just an opinion piece, which send dollar yen lower. And if I look at what the price action was there, it feels to me like we've just done a barrier hunt on the dollar yen, and those hunting it down didn't need to be long anymore, and sold their position out. So that's and at the same time this article came out. I think it's more coincidence than anything else. Anyway, dollar yen 134.77, 61.8, and then this channel we were in, and we actually back in there right now. That I'm observing and watching. So this is going to be relatively, I think, important intraday, whether to see if we can hold those things. And then you see we just went to tag this earlier in March high here and here as well. So keep an eye on what's happening in the 135 zone. Gregor also mentioned his 135.10, which is their level. So there's still very interesting levels here. if you look at it on a little bit wider, we can see that the cloud still hasn't moved. And it's still 132.56, 134.45. So I reckon for a daily close, see if we can hold 134.45. If it gets back down there, I may think that some longs in dollar yen may be a little bit disappointed there. As I said already a couple of times, there could be more to run, because now with this high inflation in the UK, it adds a bit of fuel to the fire on interest rate differentials. But I do expect next week we should be a little bit careful, because there may be some speculation around this first Bank of Japan meeting for UEDA. So I'd say, especially into next week, start of next week, be a bit careful with the pairs. Somebody else asked to look at the sterling CAD. That's an interesting one as well. Look at what happened here. This 165.5 is a very interesting level, and that was at the time of the UK Labour report yesterday, that we were turning around, and from then we've been moving higher again. So if you look at the downside, this 165.5-ish is where sterling Canada should hold right now, or we could see a deeper setback into the 164s, and why not even back into the 162s. Top side, it's still a bit struggling. This line comes from further away. I think it's already a 3-point line, so it's still, yeah, you see, it is a pretty decent line. We've been trying to take it out a couple of times in March, but failed. So this line here is still valid, 168 the figure, and then above the prior high, 168.65. Those are the levels that we should keep a close eye on in the sterling CAD. Okay. What else? Sterling yen done. I think that's about it really. Sterling Aussie, sterling Kiwi are really going to paint similar pictures. You see what I mean? We've been on here breaking these trend lines. We've been on here, and now we're bouncing again. So sterling Aussie, for instance, it's 183.95 figure, 184 the figure. Call it, give and take 5-10 points. Have a look at what's happening if it goes down there again. Otherwise, this still looks to be oriented pretty much to the top side. And that's it for me for today, Ryan.
Thank you very much, mate. Good analysis today, chaps. Very good analysis today. Not that other days aren't good, but yeah, very good one today. Lots we've chewed over, and I hope we've given the viewers a lot of good info, particularly on the UK inflation, the Bank of England, and what's going on in markets. And as a testament to you two guys as well for your input. So thank you very much for that.
Thank you, especially Kay's analysis is awesome, always.
Yeah, top notch. And thank you also to our viewers for coming and watching us here on the Flow Show. Please, if you can do us a favour, and if you see the tweets go out, give us a little retweet, give us a little thumbs up and a little like on the videos and whatnot, just to show that we are helping you out, guys. A little tick of the thumb is good for us over here. And have a great day for the rest of the day. We shall see you all tomorrow. Thank you very much.
Have a good day.
Thank you, everybody.